In this segment, we will discuss building an effective compliance management system to enhance a bank's record of compliance with the ATR rule and QM compliance. We'll now go through some compliance-related considerations. You might also find it useful to look at the interagency examination procedures and narrative for truth in lending and Regulation Z, which includes the ATR QM exam procedures. It is available in the FDIC Compliance Manual and on the CFPB website. As you may know from other FDIC examination resources, generally the components of an effective compliance management system, or CMS, include board and senior management oversight, policies and procedures, training, monitoring, and where used, audits. All supervised banks should develop and implement an effective CMS for compliance with consumer protection regulations that is commensurate with their size, product offerings, and business strategies. The options that creditors, especially small creditors that hold loans in portfolio, have for demonstrating compliance with ATR may also be a factor in your decisions about product offerings and business strategies. As we'll see, that's a good place to start when thinking about an effective CMS for this rule. Now I'll hand it over to Elizabeth to further discuss compliance management.
Thanks, Serge. Let's look first at board and management oversight. In the case of ATR QM, it's particularly important that senior management and the board have a basic understanding of the rule, because it will most often be a management or board decision as to what products the bank will offer. For example, bank management or the board may decide to offer non-QM loans only, QM loans only, or a mix, depending on business considerations and customers' needs. Another critical element to complying with this, as with all other rules, is for the board of directors or management to designate an individual to take ownership of the bank's responsibilities in this area. In larger banks, there may be several people who provide oversight, but a small bank with limited staff may only have one person who has any expertise in the ATR rule. It is important, though, to make sure there's a qualified person that can provide backup assistance when needed. An examination for compliance with ATR may begin by looking at whether management of the board has made a decision about whether it will comply with ATR by offering just non-QM loans, just QM loans, or a mix. A bank's compliance management system should reflect that decision. For instance, say that you choose to make several different types of QMs available, as well as non-QM loans. The board's decision would then be reflected in updates to the bank's policies and procedures related to those types of loans. Next, Glenn will discuss the second component of CMS, the program.
Thanks, Elizabeth. The program component of a compliance management system includes policies and procedures, training, and monitoring. Here are some suggestions regarding your bank's policies and procedures. Procedures should be established to allow employees to identify what types of loan transactions are subject to ATR and what loans are exempt. If your bank offers a mix of non-QM and QM loans, depending on the circumstances and consumer needs, your policies and procedures should provide clear and consistent guidance as to appropriate circumstances for each option. Your policies and procedures should reflect the requirement that underwriting information be considered and verified. It may be helpful to your staff to include appropriate means of verifying the underwriting information and obtaining the reasonably reliable third-party records to be used in ATR compliance. The rule and commentary lists examples. More generally, your policies and procedures should define a system for record retention. You must retain records necessary to demonstrate compliance with the ATR QM rule for 3 years after consummation. It is not necessary that you keep paper copies used in underwriting for ATR, only that you can reproduce the records. A specific item to include in your policies and procedures is a consistent method to use in calculating debt-to-income ratios. You may recall that the general or standard QM requires you to use Appendix Q, but for non-QM and the small creditor QMs, you have more flexibility to determine your own DTI threshold, as long as it is reasonable for the borrower. Your policies and procedures should reflect your decisions. They should also include a consistent method of making the calculation. Exceptions are permissible, but the reasons for exceptions should be documented. Remember, you have to calculate the payment you use to make your ability to repay determination using the assumptions prescribed in the rule. That may mean underwriting to a different payment than the note itself calls for. If the bank chooses to write QM loans, policies and procedures should describe how it will determine compliance with the points and fees cap. This includes documenting that any conditions were met for excluding charges, if any, from the points and fees calculation. For example, if the bank uses an affiliate for some origination services or settlement costs, policies and procedures should assure that all appropriate staff are aware of those entities, of how much, if any, of the charges are retained by the affiliate, and how to document that. Now, Elizabeth will discuss the training component of a compliance program.
Thanks, Glenn. Training all relevant personnel is a key component, especially for new or changed regulations. For example, if the bank is underwriting QM loans, appropriate personnel need to understand how to properly compute points and fees. Similarly, if your bank is underwriting standard QMs, it needs to understand how to compute the DTI using Appendix Q, or the requirements for small creditor QMs if the bank originates those types of loans. Therefore, effective training for the appropriate employees relevant to underwriting and originating loans is essential to compliance. Examiners may check that you have identified a person responsible for training and that appropriate personnel have been trained, or that there's a timeline for training all appropriate personnel. Effective training systems would include providing suitable internal or external training. The CFPB's website is an excellent resource, and the Bureau sometimes conducts webinars in conjunction with other agencies or trade groups. Training should focus on the level of knowledge each person or group needs to comply with the regulation. As we mentioned earlier, senior management and the board should be familiar with the rule and the basic requirements and potential consequences for non-compliance. The senior lender needs to understand more details about the rule in order to assure that oversight functions properly. Loan officers, loan processors, monitoring personnel, and internal auditors, if any, also should be trained on how to comply with the rules. Now I'll hand it back over to Glenn to talk about monitoring in a bit more detail.
Thanks, Elizabeth. An effective monitoring program is an especially important part of CMS for ATR compliance. As with the training component, you should identify the person who will be responsible for monitoring. The monitoring plan should include a schedule for when monitoring should occur. Timely monitoring will be effective in making sure that compliance systems are entrenched from the earliest stages. For example, some banks have adopted checklists for each mortgage loan file that shows that applicable ATR or QM requirements have been met. This may be an effective way to ensure compliance. A good monitoring program should include a way to test whether your training and your policies and procedures are effective. Finally, due to the importance of the ATR rule and to the potential liability for non-compliance, the monitoring program should also include a system for documenting and reporting the findings to management.
The final component of a compliance management program is audit. The FDIC determines the need for an audit based on the size and complexity of the institution. For small banks with limited mortgage lending, audit can be addressed through effective monitoring. For institutions that do have audit programs, the FDIC doesn't require that the audit be conducted by outside auditors. They can be conducted internally by someone in the bank not directly involved in the lending process. An audit program for ATR should capture some loans made since the effective date of this rule. It's another place where testing will help you determine whether your training, procedures, and monitoring are effective. If there are problems, this will give you an opportunity early to determine whether it's an isolated case or if there's a systemic problem, calling for systemic revisions.
Thanks, Elizabeth and Glenn. The ATR QM rule lends itself to some practical suggestions that may make it easier and more efficient for your staff to originate loans in compliance with the ATR QM rule. Here are some tips that you might find helpful for your procedures and training. One easy way to be sure to keep the requirements for the various underwriting assumptions straight and to be sure that they're consistently applied is to embed them in your policies tailored to each product you offer. For instance, as discussed earlier, underwriting for ATR QM has to use the assumptions called for in the rule, so worksheets or software would have to reflect, for example, the appropriate interest rate to use in calculating the payment amount to be used for underwriting arms. The CFPB website has a good chart that compares the underwriting assumptions for non-QMs and QMs. Clear written procedures as to how to calculate DTI should help ensure consistent, accurate computation. This may be especially helpful with respect to discretionary practices, such as when you may gross up income or when to take short-term obligations into account. Remember though, for the general QM, you must refer to Appendix Q to calculate DTI. Banks may use both DTI and residual income. You may also consider compensating factors. If you do consider residual income or compensating factors, a sound practice may be to describe in your policies and procedures when and how they may be considered and what compensating factors may be considered. Additionally, points and fees worksheets should build in reminders of any exclusions and any conditions on exclusions. Information used to make your credit determination for both QM and non-QM loans must be verified by reasonably reliable third-party records. That information includes income or assets used to qualify the loan, employment, if you rely on that income, and debts. Your policies and procedures and other resources might specify what are acceptable third-party records. A completed checklist would identify the verifying documents. Remember that some of your own records for other accounts the customer has are considered acceptable, reasonably reliable third-party records. For example, if you are underwriting a loan for a self-employed customer with business checking accounts, savings, or retirement accounts with you, you may use those records as verification. You might also tailor a final loan checklist for each option. For example, for non-QMs, a checklist might list the 8 factors to consider and include a listing of the verifying information you used for each of them. For a small creditor balloon QM, your final checklist might include a similar list of the underwriting factors and the verifying information, along with a checklist to make sure the other conditions necessary to meet the small creditor balloon QM status have been met. These practical suggestions bring us nearly to the end of our presentation. Let's conclude with a brief recap and then identify some resources you might find helpful.